Welcome to the Deep Dive. Today, we're digging into the prepared remarks from Dave Girouard, Upstart's CEO, during their Q3 2025 earnings call. We're really just focusing on what he said in his opening statement.
Exactly. It's always revealing, isn't it? Especially for a company like Upstart, positioning itself as an AI leader in credit. We want to unpack how the CEO frames their performance, the wider economy, and basically their strategy right now.
Yeah, what's the core message? And Girouard, he came out swinging, didn't he? Basically saying Upstart is a dramatically stronger company now.
And that the AI opportunity in credit is unimaginably large. Talking about $1 trillion industry, big words.
Especially given all the noise around interest rates and, well, economic uncertainty generally.
Definitely bold. But he immediately tried to back it up, tying it to Q3 results. The pitch was basically, we executed our 2025 plan, rapid growth, profits, and AI leadership.
And crucially, he claimed they did this while maintaining, quote, exceptional credit performance and precise macro handling. That precision point seems key.
Very key. It's all about demonstrating control, that the AI isn't just chasing growth blindly.
Okay, so let's talk growth numbers first. The headlines were pretty striking.
Yeah, they were. 80% year-on-year growth in transaction volume.
80%.
And 71% revenue growth for the quarter. That's serious acceleration.
Especially in what's still a pretty tricky environment, right?
Absolutely. And then there's the profit angle. He made a point of saying the company was nicely profitable once again.
And the GAAP net income number was interesting, too. Grew by a factor of 6 over Q2.
That's right. 6 times higher than the previous quarter. It suggests the model is scaling, efficiently. As the AI platform handles more volume, the cost per loan should ideally drop. That kind of profit jump hints that their tech advantage might be widening.
Right, the efficiency gains. But here's where it gets kind of fascinating, because you immediately see this tension between that rapid growth and the discipline they keep talking about. On one hand, huge consumer demand. Over 2 million applications in Q3.
Which was, up over 30% from Q2? Highest in 3 years, I think he said?
Yeah, highest in 3 years.
Okay.
So clearly people want the loans. Demand isn't the bottleneck.
No, demand was, as he put it, awesome. But, and this is a big but, the actual number of loans, the transaction volume, was lower than people expected.
Okay, so tons of people knocking on the door, but fewer actually getting in.
Exactly. They effectively left potential business on the table, which, for a growth company, seems counterintuitive.
So why? Why throttle back when demand is peaking? What triggered that?
It was the models, the AI. The CEO explained their internal risk indicator. They call it the Upstart Macro Index, or UMI, ticked up a little in July and August.
Just modestly, he said.
Modestly, yeah. But the AI models saw that signal, interpreted it as slightly higher risk on the horizon, and reacted conservatively.
By tightening approvals? Raising rates?
Both. Moderately reduced approvals and nudged up interest rates a bit.
Yeah.
Just tweaking the dials to price in that perceived extra risk.
Okay, so the AI prioritized playing defense over maximizing volume in the short term. And we see the impact directly in the conversion rate.
We do. It fell pretty noticeably from 23.9% in Q2,
Which is pretty good.
down to 20.6% in Q3. That's a drop of over 3 percentage points.
That translates to a lot of loans not happening. Tens of thousands.
It does, and that's the cost of that discipline we talked about. But Girouard's take was, look, the system worked exactly as it was designed.
He framed it as just a speed bump, right?
Yep.
And said the UMI had already settled back down since then.
Correct. His message was essentially, Q3 proves we don't chase volume at the expense of credit quality. It's supposed to build confidence, weirdly enough, even though volume missed expectations.
It's a tricky message to land, though. I mean, calling it a speed bump is one thing. But for their partners, the banks, the credit unions who rely on that loan flow, losing 3 points of conversion isn't trivial. That's a real hit to their volume in the quarter.
That's a fair point, a very fair point. How do they sell that to partners? Well, the argument, I think, is that the AI acted as an early warning system. It protected the partners' portfolios. He's basically saying, our AI saw a flicker of risk that others might have missed, and we saved you from funding potentially weaker loans right at the margin.
So it's about long-term portfolio health over short-term numbers.
Exactly. And he decoupled that by saying they see no material deterioration in consumer credit strength overall, even some recent signs of improvement. So the AI's move was, in their view, a very precise, almost surgical adjustment, not a reaction to some broad credit collapse, like a runner easing off slightly because their heart rate monitor says they're about to redline, even if they feel fine.
Okay, that framing makes more sense. It positions the AI's caution as a strength. But Upstart isn't just about personal loans anymore. Let's talk about the newer stuff. Small dollar, auto, home.
Right, they're becoming much more important to the overall story, no longer just side projects.
The numbers were interesting. Almost 12% of total originations in Q3 came from these newer products.
And maybe even more telling, 22%, over a fifth of new borrowers came in through those channels. That tells you something about customer acquisition, doesn't it? People are finding Upstart through auto or maybe a small dollar loan first.
And the growth rates were, well, huge, like 300% year on year for each of them.
Yeah, around 300% for auto, home, and small dollar. Eye-popping numbers.
But we need context, right? Starting from a smaller base.
Absolutely. A 300% increase on a small number is different from 300% on a large one. But still, the momentum is what matters strategically. It shows these areas are scaling up operationally.
Let's dive into auto retail specifically. What signs of momentum did he point to there?
Quite a few, actually. He said the number of dealerships, the live lending rooftops using their platform, more than doubled just from Q2 to Q3.
Doubled sequentially. Wow.
Yeah, and auto retail transaction volumes specifically jumped over 70% sequentially. Plus, they expanded into 4 new states. It shows they're building out the infrastructure, not just signing deals.
And they mentioned that new hybrid product.
Right, the auto-secured personal loan kind of bridges the gap between their core unsecured product and a traditional auto loan. More options.
Okay, and what about the home equity side? That seemed focused on leveraging partnerships.
Definitely. The angle there is using their bank and credit union partners to offer much better rates, especially to prime borrowers. He claimed they could beat other fintechs by up to 300 basis points.
3 whole percentage points. How?
By plugging prime borrowers directly into the lower cost of capital that traditional banks and credit unions have, compared to, say, non-bank online lenders. The AI identifies the good risk, the partner provides the cheap funding, it undercuts competitors who rely on more expensive capital market funding.
That's a potentially powerful advantage.
He thinks so. Girouard sounded pretty confident that improvements in automation for both auto and home mean there'll be real growth drivers for Upstart in 2026, setting the stage for next year.
All right, so product expansion looks promising. But none of that works without solid funding. How's that side looking? The CEO seemed bullish, talking about an exceptionally strong position and significant excess capacity.
Yeah, he really emphasized funding strength, and they backed it up with specifics in 2 main areas. First, the banks and credit unions.
What were the numbers there?
They added 7 new partners in Q3. He noted it was their best quarter for signing up new lenders all year. And perhaps more importantly, the total monthly funding available from all these partners hit a new all-time high.
So even after the AI tightened things up and slowed conversion in Q3, the partners were still willing to commit more capital going forward.
Apparently so. It suggests they buy into that long-term risk management story we discussed. They trust the AI's judgment, even if it means temporary volume dips.
Okay, that covers the direct lenders. What about capital markets? Institutional investors. That's often seen as a tougher crowd.
That side looks solid, too. He mentioned they now have 10 active institutional partners buying loans or participating in funding. And the key stat, 100% retention. They haven't lost a single private credit partner to date.
0 attrition among the big money players. That's significant.
It really is, especially in the lending space where funding can be flighty.
And didn't they also have a successful securitization deal, an ABS deal, in September? That's always a good market test.
Yeah, that seemed like a strong point of validation. For listeners, that's where they bundle loans and sell them as bonds.
Right.
And this deal apparently drew in 30 different investors. 7 of them were first-time buyers of Upstart paper.
New investors coming in is a good sign.
Definitely. And the deal was oversubscribed, more demand than supply, even after they increased the size of the deal and tightened the pricing favorably for Upstart. It means sophisticated investors looked at the loans generated by the AI even after the Q3 slowdown and liked what they saw enough to compete for them.
So the CEO's argument is that this partner confidence, both from banks and capital markets, boils down to trust in the AI.
Pretty much. He explicitly linked it back, saying having the best AI for reacting quickly to macro shifts is why partners stick with them and feel confident.
It really does all seem to circle back to the AI advantage, doesn't it? He even framed the somewhat complicated macroeconomy as a good thing for them.
He did. He called it the perfect opportunity to demonstrate the strength of our AI platform. Essentially, challenging times let their tech shine.
And the core of that strength is the data, right? The scale and the fact that it's proprietary.
That's the moat he kept highlighting. Over $50 billion in loans originated using the AI since they started. But it's not just the statting amount, it's the learning.
The feedback loop. Tell us more about that. What makes their data special?
Well, unlike just buying generic credit bureau data, they generate their own training data from actual loan performance. He said they have over 98 million borrower repayment events logged.
98 million data points on whether people paid back on time.
Exactly, and they add about 105,000 more repayment events every single day. That constant massive flow of real-world performance data feeds back into the models, making them better at spotting subtle patterns and predicting risk supposedly much better than traditional scores.
And that data engine is what fuels the big, ambitious vision he laid out, this idea of always-on credit.
Yes, that's the end game, frictionless finance. He painted a picture where every American is sort of persistently and precisely underwritten.
Meaning your creditworthiness is constantly updated in real time.
Kind of. So you could theoretically get the best possible rate anytime, anywhere, right from your phone with almost no application process. That's the dream scenario their AI and data are supposedly building towards.
A very ambitious goal. And he wrapped up with a pretty direct message to investors, didn't he?
He did. A bit of a rallying cry. Those who stick with the company and believe in the long-term AI strategy will be champions.
So, summing up his prepared remarks then, Q3 was really about demonstrating that AI-driven discipline comes first, even if it means sacrificing some short-term volume.
Yeah, that feels like the core takeaway. The willingness to let the AI tighten the belt even when demand is strong was positioned as proof of concept. Proof that they prioritize accurate risk management for long-term stability and that this discipline is what ultimately earns partner trust and funding.
That tension, the AI choosing caution, hitting the brakes slightly despite high demand, really defined the quarter's narrative from his perspective. And it leaves us, and you listening, with a final thought to chew on. Well, if this tension between hitting volume targets and managing risk precisely is so central to their model, what's the next step? How can they innovate further? Could future versions of their AI models get so good at calibration that they minimize that conversion volatility, avoid those sudden three-point drops while still delivering top-notch credit performance? That seems like the next big challenge for them, doesn't it? Improving the smoothness of the ride without compromising safety.